Aloha. In this video, I'm going to address taxation on life insurance. Because we specialize in the infinite banking and tax-free cash growth warehouse strategy, we stress the importance of designing policies that grow with cash value as immediately as possible and as robustly as possible. We also talk about the fact that the cash value grows tax-free. So the question often comes up, can I ever be taxed on my life insurance? First, let's be clear that we're talking about whole life insurance, and specifically whole life that is designed for the tax-free cash growth warehouse strategy. But in the broader context, let me say that term insurance is never taxed. Term insurance never has any cash value, and all premiums paid are already taxed income. So the only thing that could ever be subject to taxation would be the death benefit when it's paid out. And that, with term policies, that very rarely ever happens. And when it does, the death benefit is never taxed. Universal life insurance. Again, the premiums paid are already taxed income before being paid into the policy. Universal insurance policy can accumulate cash value, but unfortunately, due to the construct of the policy and the fees associated, any cash value is often lost before any benefit is ever paid. And again, the death benefit is paid tax-free. So what I'm going to cover here as to tax liability will apply to both whole life as well as universal policies. And remember, we never use universal policies for infinite banking. They just are not suited to the strategy. Personally, I never recommend universal life insurance. Okay, so is it ever possible that you could incur a taxable situation with your whole life policy? It is possible, but very rare, and you can definitely always avoid it. The IRS code 7702 that deals with cash value life insurance specifically exempts cash value life insurance from taxation with very few exceptions. So the death benefit, as mentioned already, is never taxed. And the cash value that grows within the policy is tax deferred. Legally, that's the way it's described, deferred. We usually say tax exempt when talking about the cash value growth in your policy, and it is as long as it stays in your policy and you don't overload the cash value to the point where it triggers a MEC, MEC. So let me explain both of those things, staying in the policy and triggering a MEC. The infinite banking tax-free cash growth warehouse strategy is all about using the cash value of whole life insurance. So how can you do that and keep all the cash value in the policy? Simple. You leverage the cash value as collateral for your policy loans. So you use the cash value as collateral, but the cash stays put within the policy and you aren't taxed on loans. And that's one reason why you don't want to actually withdraw from your cash value. You want to leverage it by taking policy loans. The other reason you don't want to withdraw from your cash value is so that it all continues to earn that wonderful dividend interest. And I'll come back to the idea of withdrawing from your cash value in a minute. A MEC, MEC, is a modified endowment contract. In the 1980s, the IRS decided it wanted to limit how much you can get away with earning in tax-free interest with your life insurance. So they came up with what is called the 7-pay rule. It's a rather complicated mathematical equation that takes into account the age of the insured, the total face value of the policy, and the minimum premium due to keep the policy in force. If you load the cash value in your policy past that specific limit for your policy, called the MEC limit, it will trigger a MEC. That is, your policy will become a modified endowment contract, which changes the definition of your life insurance. And it then becomes a taxable savings instrument. In that case, the interest earned on your cash value will then be taxed from that point on. So simply avoid overloading your cash value past the MEC limit. Now back to the idea of withdrawing from your cash value. In life insurance, a withdrawal is a partial surrender. That's what it's called, because essentially a withdrawal of cash from the policy surrenders a portion of the policy. But here's the thing. What you've paid into the policy in premiums, including paid up additions and prepaying the term portion in the design of your policy, and these are ways to load up the cash value. For more on that, see our facts answers, how can I add to my cash value? All that you've paid in, you've already paid tax on. So we call that the cost basis. The cost basis has already been taxed and will not be taxed again. But the dividend interest that gets paid to your account can be taxable if you withdraw it. Good part about life insurance is that what you've paid in will always be the first that will be taken out in the case of partial surrenders or withdrawals. We call that first in, first out. And that's how you can use your cash value as tax-free retirement income in the later years. You take partial surrenders up to the total of your cost basis, and then you take policy loans after that up to the total of the remaining cash value. So far, we've discussed how triggering a MEC and how taking partial surrenders or withdrawals may create a taxable event. The next two situations may also trigger a taxable event, and they are closely related to the surrender scenario. If you were to fully surrender your policy, that is, close it out, cancel it, whatever cash value is in the policy would then be returned to you. And if there's more cash value than the cost basis, that is what you've paid in as after-tax dollars, you would then be liable for tax on the gains that your cash value had earned and was then paid to you. Then if you just stopped paying the premiums due and the policy lapsed because there was no automatic premium loan provision, which would be very rare, it would be the same as if you just surrendered the policy and the cash value would then be returned to you. And if there were gains beyond the cost basis at that point, again, you'd be liable to pay tax on those gains. In any case, whether it be a MEC, a surrender, or a lapse, the only taxable amount would be the gains beyond the cost basis. Please post your comments and questions here, and please subscribe to this channel. And if you haven't yet, you really should watch our free webinar, How to Become Master of Your Financial World. Just click on the link in the description box below. For now, aloha and mahalo for watching.